Welcome to What's in Store with Carly and Chris, the show where we cover hot topics at the cross-section of retail and real estate. I'm your host, Carly Iacono, and I'm joined by my co-host, Chris Ressa. Chris, good morning.
Good morning. How are you?
I am amazing. How are you today?
I'm doing great.
You're hot off spring break. You feeling rested and recharged?
Feeling rested and recharged.
Looking tan?
Yes.
So
spent a lot of time. I got some vitamin D.
Good. So
Yes.
Now you're ready to go into intense conference season.
Yes.
All right. So today we are talking about some of the main themes and discussions we think we're going to hear at ICSC, kind of what's going to drive ICSC Las Vegas, which, as we know, is the Super Bowl of retail real estate. So, we often do hard predictions. Is this going to come true? Is this not going to come true? And we're going to take a slightly different approach today and talk about the main themes, what we think will be driving discussions at the dinners, in the hallways, and of course at the meetings in the booths as well. And there's three sort of general areas that we think will dominate the conversation. You ready to get started?
Let's go.
Let's go. I like it. So the first one is market sentiment and buyer demand. And this sounds a bit general, but there are some sort of overall themes that weave through both tenants, both buyers, sellers. But before we go into what those are, I want to kind of set the framework, right? We've talked about this a lot. Vacancy is still at a historic lows. We are just a touch off the tightest retail vacancy we've had in 10, 15 years, right? A very long time. We have retail construction, still absurdly expensive, very, very difficult to execute, right? So we have limited new supply. And we have very strong retail fundamentals for a prolonged period. So when you have well-performing assets, what does that lead to? More buyers that want to get in on the fun. So you couple all that together and you kind of have this perfect storm of demand that is very difficult to meet. So I think that's the theme we're going to see throughout our discussions, again, both on the buyer side and on the tenant side. Where's the product? What are your thoughts?
Yeah, on the tenant side, I think it's the same thing, which is there's, as the buyer side, which is dry powder on the sidelines and a yearning for growth. And so when people have capital and they want to grow, in our space, they usually want to buy property and open stores. And I think this is, when we were at the New York ICSC, that was, it was very positive in that regard. And then as we went to the open air conference in Arizona, that, optimism continued. And as I sit and I'm on the call and I'm in meetings with retailers across the country, that's the same sentiment that I hear, which is have the ability to grow. They've got a long track record of performance now. And I think that's one of the more interesting things. They're not just looking at, how have they performed over the last, quarter. They're looking at a long trajectory of performance and a forecast of what they think that will be. And that's leading to the prospect of growth for many retailers.
And I think overall allocations into real estate, we're kind of switching back to the owner investor side, are up. I believe the predictions are 55% increased allocation to commercial real estate from other investment types for 2026. That's significant. So that money needs to find a home and it needs to find deals that pencil and that make sense. And if we have continued new supply, it's just going to get tighter and tighter, right? And we have the existing owners and operators who have had that really good run. They're certainly not looking to exit. They're trying to grow too. So I think the challenge is not just retail real estate is euphoric and wonderful. And, again, I think as an owner operator in your space, it probably is. But it's almost this angst, this how do we get in? How do we grow? How do we find deals that make sense? So there's going to be a bit of optimism and kind of patting everyone on the back if you're on the ownership side and you had a really good run, and which is going to continue. But I think on the buyer side, it might be a little more frustration almost, right? Like, I need to get out there. Show me the deals you have. Where's my entry point into this market, and how do I find upside? And there'll be a lot of discussion on what do you have off market? What do you have coming to market? I'm not seeing anything I like. What else can I do here that's going to drive some of that buyer demand?
Yeah, I think, one of the good things I think is when you compare to the other assets in commercial real estate, I think retail's still super favorable, right? Comparative to, multi and industrial, I think it's still pretty favorable. And
why do you think that is, though?
I think yields are still better,
Yields.
right? Yields are still better. And then, obviously office is making a comeback, but that's a specific skill set. It's I think you need a specific risk appetite and view to the future and long-term, a long-term view that is unclear in some regard, but obviously it's improving. So it makes retail, this desirous, asset class. That said, if you look at any asset class, whenever it's doing really well, it's never easy for any asset class for someone to come in and jump in and take share. And I think, people are desirous to do it because, yields are strong and things are going well. But that doesn't mean that it's going to be easy to come in.
And I think we're still seeing a bid-ask spread, at least in my world, gap. It's closing, right? Sellers are becoming a little more realistic. Buyers are becoming more realistic about what they have to pay to get in. But there's still a gap, right? Sellers are saying, we know there's not a ton of quality product. There's a lot of product on market that is challenged in some way, which I can touch on. But the really strong assets that everyone wants, or the ones with some upside, there's not that many, and sellers know that. But buyers are sitting on the sidelines going, but it has to pencil. I still need a pathway here. So there's still, and I guess this is, why my job exists, there is still this push and pull between buyers and sellers on the bid-ask spread with pricing that we're trying to navigate.
Yeah, I think the benefit to that is that, and you mentioned the upside is, and today, and we spoke about it, is it's going to be operator driven. It's no longer right now. It's about the fundamentals and how about the rent roll and the NOI of the property, and not about financial engineering. And I think that's a healthy place to be for an asset class, even though that might be harder and less easy money can benefit, but it is probably long-term better for the asset class.
I completely agree. And I think that's one of the structural changes we've seen, which kind of goes into our next theme that we think will be a hot topic at ICSC. And that's the way assets are valued. The underwriting is fundamentally changing. So for years, I think it was probably 15 years, we had cap rate compression. So you could model an exit cap rate that was significantly lower in some cases than your going in cap rate. And the deal was very easy to underwrite, right? And make it look fantastic. I think that mindset is gone, right? No longer is it really rational to pro forma an exit cap rate that's lower. So we're seeing the valuations be more
significantly lower.
Significantly,
right? You
25 basis points, maybe you get 50. I don't know. You're modeling exit cap rates significantly lower?
We're pretty conservative on what we model on an exit, but I don't think it's one size fits all. It's what I would say is, modeling hundreds of basis points of compression is probably a little bit more risky, than maybe it was in 2013.
But I think there is a difference here and a nuance to your point, because if you're making a substantial change to the asset, let's say you're replacing a vacant box with a grocer.
That's right.
Obviously, there's going to be cap rate compression there, right? That's a completely different story. But if you're buying an asset, you're not making meaningful changes in terms of re-tenanting. I think it's safe to say the exit cap rate is going to be kind of on par with the going in cap rate right now, right?
Fair enough.
So it becomes a valuation. It's an income play now. It becomes an operating business, less of an appreciation business, again, unless you're making structural changes to your tenant base. And that wasn't the way some investors were looking at it for the last cycle. So I do think that's a meaningful change, that we've become an operating business, not an appreciation.
I would say it's definitely hopefully becoming the age of the operator, and the strongest operators will do the best. But we say that's a change. I would say, by and large, the scale at which it was the other direction, where it was just let's buy it at an 8 and finance it at a 3, that whole world, that was pervasive in a short period of time, call it '08 to 2019. But before that, and the how this business and commercial real estate grew, and now after that, are back to its roots of it being, operator driven and about the rent roll and about the NOI. And I think that's okay.
You're happy with it?
Yeah, I think, and at the end of the day, I think that, we say it's a big shift from where we were in the past decade, but not over the lifetime of the actual. There was always, there's always somebody in the background who's trying to financially engineer a deal to make it work. But historically, our business was about the NOI and was about the rent roll and was about the credit profile of the tenancy and was about driving sales to the asset and driving traffic. And we entered this period where so many people were able to financially engineer new capital coming into the space, deals to make work. But I don't think that's the historic way. I think we're moving back to more of the roots of how the industry started and what made it great. And that's okay.
I agree. I think it's a much sounder place to be, right? Because you're looking at the real estate fundamentals, you're looking at just a more stable asset than just banking on financial markets to pull you forward.
Yeah.
How are the tenants looking at this? I mean, that was all owner-operator commentary. How are tenants moving forward in this space, and how is that different than 10 years ago in your mind?
So I think it's very similar to the buyers, which is there's capital to grow. Retailers want to grow in a measured way. It's super tight and hard to find space, but I think many are attacking when they do. And I think that's how retailers are looking at it. Many have their pedal on the gas.
Pedal to the metal, I think is.
I was going to say they have their foot on the gas. They want to grow. I think with data and institutional knowledge and experience, they're putting themselves in a position to make less mistakes than they have historically. And I think that's a good thing. But yeah, they're all systems go, which I think is great.
For sure. Definitely helps the industry overall. Let's touch on something that could be a headwind that we think will come up. I don't know how much. It's going to be interesting. And that's the geopolitical, I was going to say tensions, but it feels just like complete chaos, a little beyond tensions, if you will, at this day to day. How do you think this is going to impact sentiment?
At the moment, I think when I'm talking to retailers and other owners, they're focused on what they can control. And I think that's a good place to start. There's, so many different things going on around the world. I think it's hard to focus on every one. It'll definitely be a discussion because it's so sensationalized in the media. So I think it will be a topic of discussion. I don't know how actionable any of those pieces will be. Obviously, the stock market is super reactionary to it. I think the retail real estate industry has been, more focused on what they want to work on. It comes up less in the discussions that I have with tenants on a regular basis. And I think it will come up as a topic, the geopolitical, sentiment, but I think it will, I'm not sure if that will be the dominant discussion at the show.
I've heard it a lot in the last few weeks, primarily as it relates to financing, right? Because everyone's looking at the spread between cap rates and interest rates and their overall return, but not as much as you would think. More of a, do you think this is going to get worse and there's a chance rates could go up, right? not is this going to delay when rates go down? Because for the last 3 years, the conversation was, let's wait because we think rates are going to come down. And let's wait to refi. Let's wait to buy. I don't hear that anymore, which is really interesting. I think everyone has accepted the rate environment. And like I mentioned before, and you touched on as well, it's not financial engineering. It's an operating business. And if the deal makes sense with the current NOI, buyers are going to go for it. They're not waiting for the Fed to do X, Y, Z. So I think that's playing through to the other side too. When you have oil prices spiking, you have inflation that is really not able to be controlled by monetary policy very easily. Buyers are saying this is what we have. I hope rates don't go up. They're probably not going to go down, and let's just forge onward. But it is a discussion point of just kind of a quick touch base. What do you think? Is this affecting other investors? Are people holding off? Are they rate locking? Are they not? So for me, it's part of the financing discussion, but not part of the overall long-term stability of the asset.
Yeah, I think when I think about like these world events that dominate discussions, if you go back to 2020, COVID was like this discussion that dominated everything. And I think it impacted everyone's personal, professional life on a daily basis all the time. And so it had to be the discussion point. I think it's different when you have different geopolitical issues. That this one is different than that from just a topic of discussion. People were getting sick and things were going on, and they couldn't get their kids' schools were shut down.
Personal,
yeah,
right. And people wanted to talk about it as a way to connect with other people.
It's not downplaying either political tension or thing that's going on. It's just that I think it will be less of a dominant discussion, albeit it'll be touched on for sure.
It'll filter in.
Yeah, given the sensational nature of the media for sure.
And then back to the deals, right?
Yeah.
So the last thing I want to touch on is completely different. And this is the pervasive nature of the AI discussions. And I think you and I feel slightly different about this, although maybe you're coming around. I think AI is going to be part of almost every discussion. And this is starkly different than what we saw at ICSC New York back in December. I feel like in New York, there were some sessions on it, but it wasn't part of either of our meetings, right? When we debriefed after, I wasn't sitting down with an investor reviewing deals. And then they said, well, what about AI? How's that changing your business? Did not come up. I think this time it might. And there's a few structural changes, right, to the conference that are going to make a difference, right? ICSC is running their PropTech track, which is a full day of programming on PropTech and AI. So I think that's going to set the frame. It's at the beginning of the conference. But do you think it's going to go beyond that and into your meetings at the booth that are not specifically scheduled to be about AI?
I don't think as much as our first point on the buyer and tenant sentiment piece and the supply and demand and the deal focus. But yes, I'm obviously, as you know, deep and focused in navigating the AI world. And it's the past few conferences has been a discussion, but you and I have thought it would dominate, maybe because of the ICSC's push on PropTech and AI, it will be more. I'm not sure it will dominate. At Open Air, I was surprised it didn't as much. It was talked about, but it didn't dominate. And here I was taking Waymos because I had never taken a Waymo before and trying to get my arms around how that all worked, which was fascinating. And I had a pretty good experience with it. But I'm not sure it will dominate the conversation. We'll see. I was, the people I was meeting with were very focused on at New York. We're very focused on their task at hand and what they were trying to accomplish at the show. And it was less about how they're using AI, albeit everyone's trying to figure it out. And it certainly feels like the technology is way past, is way ahead of adoption right now, right? There's things that the AI can do, and people aren't using it for that because it hasn't been adopted yet. And we'll see when that gap closes between adoption and actual capability.
I think that's the inflection point we're all waiting for. When is this not just discussion and learning? And when is it, okay, here's my return on investment of XYZ AI tool. Here's what we saved. Here's how we found a new deal, whatever the outcome is. But it's too new and too chaotic right now, it feels like, to have like KPIs that are trackable for most clients, right? Or most owners. But that's going to be changing. And I wonder when the discussion shifts from what neat new tool are you using, or how are you using agentic AI to save time in your everyday life, to here's what we did last year, here's how we're using it. I need you to give me XYZ deal in this format so I can feed it into my AI and save time.
Well, I think from how you just described it, I think that will be a discussion of like, you know, you and I have talked about how do we use it personally, right, to like optimize and save time. But I think when it comes to these conferences, a lot of the discussion comes to like, how do we aggregate data and improve workflows across organizations and change historic industry norms? And those take time and are really big challenges, which is very different than how do I set up something personally so that I get a reminder every day automatically?
Right. I feel like we've started to go past that use case.
Yeah.
Right. Of just, what are you asking Claude today, you know, to improve in your life? I feel like that's pretty elementary. It seems elementary, but a few months ago, that was really like a fascinating conversation. Just you and I were having about how are you using this every day? Now it's what are you building? Not what are you asking? And
Yeah.
I think that's an interesting pivot point. But there's also a lot of discussion between what tool are you using or what are you building? And I think that's kind of an unclear perspective right now. Are companies making their own systems, you know, based on one of these large language models, or are they beta testing and trying to find a tool that they can implement themselves? I think both. And a lot of company, I know at CBRE, we're trying both. But what's going to be the quickest path to an efficient outcome? Nobody knows yet.
Yeah.
Because there's a new tool, or not a new tool. There's probably thousands of new tools every day. And it's really difficult to figure out what's going to work and have the best trustable, if that's a word, outcome from the models. And I think that's where we're all kind of getting stuck. Like there's so much information. Everyone knows we need to use this and adopt it, but what's the best next step for the organization?
Yeah. And I think one of the things when everything is new and every day there's a new better, it's hard to buy today the tool because you're sitting here going, well, tomorrow it's going to be dated and better. And I think we're in that place. And I think it took software a long time to get out of that place. And I think AI will get out of there quicker. But as it relates to the ICSC, I think it will be discussed. I'm not sure it'll dominate, but we'll see.
I think it depends on the meetings, right? We're both speaking at ICSC PropTech on a few different capacities. So that day, I feel, of course, will be all AI, all PropTech. It'll be a big learning day. But then when we move into the later days in the conference, especially the deal-making days, I think it will be a discussion, quick, you know, how are you using it? Have you had any success? What tools is your company implementing? But it's not going to drive the full discussion because everyone needs deals.
Yeah.
And we're going to be back to show me the deals and I'll show you the money.
That'll be the discussion.
Yeah. That's the takeaway.
That's going to be the dominant discussion right there. Show me the deals.
And I'm ready. I mean, I don't know about you, but that is literally my
buyers,
whole job.
tenants, landlords, brokers, everybody, you know, capital, it'll be show me the deals.
Exactly.
I think that's what's going to dominate the show this year. Everyone's ready for that.
Can't wait. Well, I wish you a very successful ICSC.
Same to you.
I'll see you out there and hope it's a good show for everyone.
Sounds great.
Thanks so much for tuning in. That was this episode of What's in Store with Carly and Chris. We hope to see you in Las Vegas in a few weeks. And if we miss you, be sure to tune in very soon. Have a great day, everyone.